To Team Wealth Live, Matt Sorensen. Excited to be here today. It's officially summer here in Phoenix. It's over 100 degrees. It's freaking hot. And when summer hits, I like to think about summer school. So that's what we're doing today. We're doing self-directed IRA summer school today. We're going to be answering your questions, which we have a lot of them that have came in about how to self-direct your IRA, some of the roadblocks people see, some of the structures, and can I do this or not? I'm going to get into those questions. We've got a lot of them today. Now, if you're on live, we always take priority to live questions, so hang in there. We're going to get to you if you're on live. We'll get to your questions, but I do want to jump in on some of the questions that have already came in. We have some of them queued up to answer. A lot of great questions that are common, that people have, some of the common roadblocks or questions people have about how do I self-direct, can I do this or not? So we're going to hit a lot of those questions. Now, we're here every Monday going over ways to better take control of your financial future, save on taxes, protect your assets, build your retirement, grow your business, all that stuff. We're hitting that every Monday. So make sure you are subscribed to the channel. We have a private Facebook group we're going to be interacting with a lot more in the future, so you can join that as well. Now, I'm Matt Sorensen, wealth lawyer, attorney, helped clients for over 20 years as a business and tax lawyer, helping them grow their businesses and do all these things I talked about to take control of their financial future. I'm also founder and CEO of Directed IRA, Directed Trust Company. We have $1.8 billion in assets. We built that in over 5 years. We're growing quickly, set up 750 new accounts alone in April last month. Of people taking control of their retirement, using retirement accounts to invest in alternative assets. Now, a self-directed IRA is essentially an IRA that you can use to invest in any asset allowed by law. A lot of people think of an IRA and they think of a brokerage IRA, and they think of their IRA that can buy a stock, bond, or mutual fund. Guys, IRAs, traditional IRAs, Roth IRAs, SEP IRAs, that's not the only type of IRAs. You can have an IRA that's a Roth IRA, that's a traditional IRA, that's a SEP IRA, that can invest in non-publicly traded assets. You can own a rental property. You can own the duplex down the street. You can invest in a small business in your community. You can invest in a startup, buy crypto, invest in an LLC with some other people doing a business or a real estate deal. These are all assets that an IRA can own, and you've always been able to do that. IRAs and 401ks have always been able to own these quote-unquote alternative assets or non-publicly traded assets. The problem is most people have not been told that, because the financial services industry and broker-dealers have dominated the retirement account landscape. And so when most people think of an IRA or 401k, they think of a brokerage account that is an IRA or 401k. When you have brokerage account, publicly traded options. So many of you here, you know that, and I'm preaching to the choir for most of the people on here, but I just want to give that little explanation before we dove into the topic, because people watching this new might be like, what the hell are they talking about, a self-directed IRA? Does that mean my TD Ameritrade account where I get to pick which stock I buy and sell today? No, we're talking about really having access to investments of your choice. Okay, and there's very few restrictions on what you can invest into. All right, but let's get into the questions here, and let's start with the YouTube questions that came in. This question came in from Richard. He said, real estate and a self-directed IRA with an LLC like you suggest. We'll get to that. He says, what if you have an extraordinary expense like a new roof and the self-directed IRA doesn't have enough money and no other IRAs to transfer money from? Okay, great question, Richard. So what he's saying here, and let's just look at I have this little diagram out here already, actually. So Richard's saying, let's say I've got a self-directed IRA. I had money at Fidelity IRA. I moved it over to a self-directed IRA at Directed IRA. And then that money invested into an LLC that the IRA owned 100%. I'm the manager of this. I don't own it personally. My IRA owns it 100%. I don't get paid to be manager, but I have authority to act for the LLC. We have a lot of other videos on that, a lot of other trainings, podcast episodes on how that works. 3 chapters in my book, the Self-Directed IRA Handbook. So a lot of other content on that. But he says, all right, now let's say it's going to buy real estate. And let's say I put $150K in this thing and bought a property for $150K. And let's say the roof goes bad and I got to come up with $20,000. What do I do, Matt? I don't own this, so I can't just put in 20 grand. My IRA owns it. And let's say I can only put 7K in as an annual contribution in the IRA that could then get to the LLC. That's only going to cover 7,000 of the 20. I don't have money in my other brokerage IRA or other accounts I could roll over to this IRA here. So what do I do? How do I cover that expense? Well, first off, let me say, we want to plan so you don't get into this situation. As a rule of thumb, we like to recommend clients have 10% of funds not in the deal that they could use in the event of an unexpected expense. Now, in this case, that would have only been $15K. So you're still short 5. Maybe you can make an IRA contribution. But to get to Richard's specific question, let's say I've exhausted all ways to get money into the LLC and I still got to come up with 20K. Well, you can't just write a check in or loan money to your own IRA to do the deal. What you can do is, the first option I would do is a third party loan. Have a third party that's not disqualified. So this can't be your parent, your spouse, your kids. Have a third party loan the LLC the 20K, as I'm just using this example, that could then cover the roof. And then you would agree, the LLC would agree to pay that third party back. All right. And now there would obviously be interest on that. Someone's going to lend you money. They're going to typically charge interest. That's the first and most common way people resolve this situation. Now, the second way you would resolve this is there is something called there's a privilege transaction exemption 80-something. It's in my book, the Self-Directed IRA Handbook. It's privilege transaction, I think it's 80-20. No, that's not right. Privilege transaction exemption, Anyways, there's a privilege transaction exemption on this. This is in my book. And it basically says, if you are at risk of loss of the asset or destruction of the asset or investment, in other words, really the roof is gone, it's going to take 20K, you don't have 20K. And if it rains, it's going to destroy the property and cause tons of damage. You can actually loan your IRA money from yourself. You could loan this 20K to your IRA. There's a specific note that has to be created. You're relying on this exemption. And then that money could be used to cover the repairs. And then the retirement account ends up paying you back. Now, this is a specific privilege transaction exemption. This is not something you're going to talk to any customer service person here or any other company about how to do this. You'll need to have lawyers involved. This is a complicated, little narrow exception, but it is there. And it's in my book. I reference it in my book in the real estate chapter on where you can, if there's like loss of asset or specific reduction in value, basically an emergency situation, you can do this. You cannot loan your own IRA money to just go buy an asset or to improve an asset. But if this roof was really at risk of ruining the whole property and you had no other way of doing it, you could save the property by putting in, lending your own IRA money, which, by the way, it has to be done in a specific fashion. There'll be a general authorization, a specific note, and reliance on this exemption. Okay. I don't know why I picked that one off the bat, Richard. That was a little tricky one, but for anyone just investing with a self-directed IRA, particularly real estate or assets that could have expenses that could come up, maybe you have a tenant out or something like that, make sure you have some cash available to cover those expenses, whether it's in the LLC checking account or money in the IRA that's maybe more liquid, invested in stocks or other assets that you could get access to in the event of an unexpected expense. All right, let's stay on the YouTube questions. I'm just going to go through the YouTube questions. We'll hit the Ask Matt questions that people asked on the website. And then I got some Instagram questions that came in as well. All right, so this came in from Stickler1. Says, excellent content and surely plan to do something with your organization. Thank you, Stickler1. It says, question, could you have more than one LLC feeding into a single self-directed IRA account? I ask because there's a general thought, especially when investing in real estate, to keep each investment property separate for liability purposes. Okay, great question. So what Stickler's asking is, let's say I've got an IRA and it's going to invest into an LLC that's going to own a piece of real estate. Now, let's say he wants to own multiple properties. Let's say he's got, well, I've got 3 properties. All right, now he could do that, and many clients would do this. They'll have multiple assets in one LLC. It's up to you. For retirement account rules, it's really just a choice for you. Now, Stickler1's saying, I don't love this for asset protection because if I got a lawsuit on this property here, they can sue the LLC. They can't sue the IRA or sue me personally, but they can sue the LLC. And you know what? That LLC owns 2 other properties. So they can get at the equity in that property where the lawsuit arose, plus the other 2 properties, any of that equity there, which is the value and the assets of the LLC, that would be at risk. So we generally don't like to put too much assets into one LLC. So what Stickler1's saying is, can I have my IRA own another LLC that in turn owns the properties? And so here, what we're going to do is we just have 1 property per LLC. Now you could do this. Now, the difference is this costs more money, right? You've got multiple LLCs. There's a cost of setup. Some states have a $50 to $100 state filing fee per LLC. California's $800. Arizona's zero, by the way. It varies. Most states are $50 to $100. But you have the cost to set it up, so there's a little more cost on the front end. Our law firm, KQS Lawyers, where we set up IRA LLCs and have for 15 years now, we charge $1,200 for an IRA LLC. So stickler one, yes, we like that from an asset protection standpoint. So it's optional. If you've got a lot of equity here in these properties, and I'd say more than 200,000 of equity, I like using separate LLCs per property. If you're buying properties and you're doing seller financing on them or getting non-recourse loans or something, and there's less than 100K of equity, 3 properties, I just keep them in one LLC. But if you're like, no, I'm throwing down some serious cash from the IRA, or I'm getting good deals on these, or they've appreciated in value, you may want to separate them into separate LLCs for asset protection purposes. Okay, great question there. All right, RJ asked about Social Security payments. I've done some content on Social Security and how that works. We had a great Directed IRA podcast episode on how to think about Social Security, how to plan for it, what the typical benefits are going to be. For me, someone in my 40s, I was a little surprised by all this and the numbers and how it works. How does the spousal benefit work? So make sure you check out that podcast Mark and I did. I think that was on the Main Street Business podcast, but check that out. We also did some episodes on how your IRA or 401k is protected from assets. Your IRA or 401k can be kept even if you file bankruptcy. You got creditors chasing you down, a credit card company, a business deal gone bad. I don't care what it is. If you have a lawsuit or a judgment against you, they cannot attach your IRA or 401k. It's freaking awesome. Your IRA or 401k are protected from creditors. That's one of the benefits that Congress created when they let you have IRA or 401ks is they said, all right, we're going to give you tax benefits to put the money in, tax benefits as you grow the account, but also we're also going to give you asset protection in your IRA and 401k and not let creditors go after it. So that's one of the great benefits of IRAs and 401ks that a lot of people forget about. Now, Social Security, as to RJ's question, is also protected from creditors. So if you have a lawsuit or a judgment against you, and let's say you've got your Social Security check coming next month, that hits your bank account, a creditor can't go after that. Social Security checks are exempt from creditors. Now, there's 2 exceptions of where you could lose your Social Security from a creditor, and they're the typical places you might think. The IRS gets an exception. So now Social Security money hits your bank account, the IRS can take it right back. Okay, so they could blow through that. There's no creditor protection from the IRS. The second is child support. If you owe child support and you're on Social Security, I mean, you might have had kids later in life. I don't know, maybe a second marriage or third marriage. I don't know. But a child support judgment is also something that a creditor can go right through and into your Social Security payments when they come in. So in general, though, Social Security is exempt from the typical creditors. It's just the IRS and child support that could still attach and get at your Social Security. All right, Sonia asks, we're still staying on YouTube questions, and thanks everybody for dropping your questions in on the YouTube videos or on prior lives. We appreciate that. We love grabbing these, and we're going to comment back on each of these questions to let you know we did answer it as well. So Sonia asks, what are the rules on Roth IRA contributions for people that max out 401ks but make less than the max for high income earners? Can you still contribute to a Roth IRA if you contribute $100 less than the 401k max contribution? Okay, Sonia, so good question. You can still contribute to a Roth IRA and max out a 401k, and you can just do a regular Roth IRA contribution. A lot of times when I describe a backdoor Roth IRA, I talk about people who are over the income limit for Roth IRA contributions and have a 401k at work that they've maxed out and they want to do more. You don't have to max out the 401k. That's not a determination here of whether you can make a regular Roth contribution. So there might be some confusion there on how I typically explain it. But let me just say this. If you have a 401k and you're under the income phase outs for Roth IRA contributions, which we can look them up here. We'll drop them in the chat for single versus married. It's in 150K or so single, 200K married approximately. So let's say you're over those, let's say you're under those, but you've maxed out your 401k at work. You can still go do the 7K in a Roth IRA. No backdoor required. Just go right in the front door, the regular Roth IRA contribution. But most people who are maxing out their 401k at work and want to put more into a Roth IRA, they typically are over the income limits. They just, have that much available to put and save aside. Typically, you would have you'll be over the income limit, so you'll need the backdoor Roth anyways. Now, here's another cool strategy though. For those of you that have a 401k at work, you can do what's called the mega backdoor Roth and do even more than the backdoor Roth IRA. Okay, let's go through the mega backdoor Roth here. I want to hit this because this is a really cool topic. All right, mega backdoor Roth. If you have a 401k at work, and let's say you can put in $23,000, okay, that's the 2024 amount for employee contributions. You could do it as Roth or traditional. Now, let's say your company has a match, and let's say the match from the company, in your instance, they put in $5,000, okay? All right, well, that's $28,000 that you have in your 401k. Now, Sonia was asking, can I go do a Roth IRA? Yeah, you can go do that. You can still go do $7,000 in a Roth IRA, but how could I do even more than that? How could I do more than seven? You can put $69,000 a year into a 401k. But Matt, I already maxed out the 23K. My company threw in a $5,000 match. I've got 28K in there. What I'm telling you is you can put 31,000. Excuse me, let's see. You could do 41,000. Excuse me. What I'm telling you, let me change that. What I'm telling you is you can put 41,000 more dollars into the 401k as what are called after-tax contributions. These after-tax contributions, by the way, can be rolled out to a Roth IRA. You don't get a deduction when you put them in, but you can get up to $69,000 total into your 401k. Now, if you're a solo 401k owner, you can do this. If you're a business owner with employees, you probably can't. If you work at a big company, even if you're a high income earner, you can probably do this. All right. So there's a weird category of who gets to do this. Solo 401k owners with no employees in a plan, and people that work at a day job or have a other employer where they're not an owner, but they want to max out the 401k. Those of you that have your own business though, you can't do this. Okay. It's just, if you own your own business that has employees in it, the mega backdoor Roth doesn't work. But we see this work the most, actually, people that have kind of a corporate job, day job, 401k. They want to do the mega backdoor Roth to get more money into retirement accounts. They're like 7,000 in a Roth isn't enough. I can drop another 41,000 in this example here as after-tax contributions into the plan that, by the way, are not locked into the plan, that can be rolled out immediately to a Roth IRA. So that's the mega backdoor Roth 401k. Awesome strategy. And Sonia, that might be something you're looking at doing because you're already maxing out your 401k. You're looking at doing a Roth IRA on top of that. Also look at doing the mega backdoor Roth 401k. All right, we have a question there. Tristan's got the mic in his hand. So,
yes.
All right.
All right. This is from Bill Fleming on Facebook. I'm looking to move forward with a Roth IRA LLC, and he's going to be buying crypto. And I want to know if I'll have to file taxes on each of my crypto transactions. Also, if I pay for an app that assists with my trading efforts, do those funds have to come from the LLC account, or can I pay for any of those apps out of my own pocket?
Okay. So what was his name?
Bill Fleming.
Okay, Bill. All right. Bill's asking here, I'm going to do a Roth IRA. And I want that IRA to invest in an LLC. That in turn is going to go do crypto as an investment. Now, your IRA can do crypto. By the way, we have a crypto IRA product where your Roth IRA does crypto directly. You have a Gemini trading account. It's more streamlined. It's easier. All these tax reporting questions you're asking are not going to be an issue. They're going to be freaking simple because your Roth IRA owns that crypto trading account. But what was his name again? Bill?
Bill Fleming.
Bill says, I don't want to do that. Maybe he doesn't want to be on exchange, or he doesn't like Gemini or whatever. I don't know. He's like, I'd rather do it in an LLC. I'm going to do other crypto deals. And that's fine, but you're going to have a lot more complications, and hence some of your questions here. The easy answer to let me go backwards in your questions. If you're using some type of system or something, or software or service to help with your trades and transactions for your Roth IRA with the LLC needs to pay for it. You can't cover the expenses personally for that if it's entirely built for your Roth IRA and the LLC here buying and trading crypto. So the LLC would need to cover any expenses that you might have. So let's, the LLC is going to cover, oh, good Lord. The LLC is going to cover any expenses here. So let's add in expenses. Now, what about tax reporting on all the trades and stuff? Well, at the end of the day, there's no federal tax return for your LLC in this example. Your Roth IRA owns the LLC 100%. Now, if you're on a exchange or you're trading somewhere, you've got to get on exchange to buy and sell, typically at least. That exchange is going to generate some tax reporting forms, and those forms are typically going to log the buy and sell of the trade. Now, the problem here for you, Bill, is what do you do with those? How are those getting reported? Hopefully, you've set up the account right, so it's using the LLC's EIN, and the LLC has the Roth IRA's EIN, which is our EIN. Don't get a good new EIN for your Roth IRA. We have a reporting EIN that you can use. And but that LLC is out there doing the transactions. Okay, and let me actually clarify this. In an LLC, when you're getting the EIN, we're actually using your social, but we're designating it to be your Roth in this instance, just so you know. And this is for single member LLCs in general. So I have a whole page on my website, by the way, on W-9s and how to complete a W-9 for your IRA LLC, because this is where all the tax reporting is going to be driven. When you are using an LLC to go make transactions, whether you're buying real estate and dealing with the title company, you're dealing with a brokerage company or a crypto company or an exchange, they want the W-9 for the LLC. And so we have a form that about how to complete the W-9 properly. All right, so basically what I'm saying here is, Bill, it's all going to be up to you. You're a pioneer out here doing this. It gets messy. I'll be honest. I've seen over the years, clients are very messy with their crypto stuff. What's taxable, what's not. My IRA owns it, so what's the big deal? But you're going to need to keep really good records on this, on the buy and sell. And you got to be very clear wherever on exchange you are, if they're reporting trades to the IRS, that they know this is owned eventually by your Roth IRA, so it's getting reported as not being taxable. If you're doing the crypto Roth with Gemini that we have, it's already set up in the system that this is owned by a Roth IRA. So there's no tax reporting going to you, to any LLC, or to your Roth IRA. So that's, excuse me, one of the reasons, frankly, I use that structure for myself in buying and selling crypto for my own account. So, but you can still use the LLC. You're okay with that. I'm okay with that if you want to use that structure, but just know you're pioneering this on how it's going to work for crypto. And everybody's trying to figure out the taxation of crypto anyways. So that might not be a very clear answer, Bill, but that is where we're sitting in terms of the law and just the practical implications of using an LLC owned by a Roth IRA to buy crypto. It's possible you can do it, but it might be a little clunky. And the tax reporting is probably one of the biggest areas that could be a little messy because no one knows what the heck that really is. And the crypto space in and of itself and the exchanges and how the reporting trades are brand new. They're all trying to figure it out themselves. All right, let's go to, do we have any live questions? All right. Okay, let's go to some of the Ask Matt questions. By the way, you can get over to mattsorensen.com and ask me any questions there. You can record some audio questions if you'd like, or you can just type in your questions. So Toby asked a question, says, I know that a solo 401k is exempt from most forms of UBIT, but not all. If my self-directed 401k LLC invests in a syndication that is purchasing 140 apartment units and rehabbing them and paying interest and profit sharing, will the interest and profit share be subject to UBIT? There will be debt on the property. Thank you, Toby. Okay, great question, Toby. There's a big misconception about solo 401ks. A lot of people improperly say and claim solo 401ks are exempt from UBIT. That is not correct. That is wrong. Solo 401ks are exempt from some kinds of UBIT. Actually, one type of UBIT that it is exempt from. It's called UDFI, unrelated debt financed income. That is the only type of UBIT that solo 401ks are exempt from. Now, for Toby's question, it happens to be the type of UBIT that is exempt. So this is good news for Toby. So let's break this down in the diagram here. Let's say Toby has a solo 401k. By the way, that means Toby is self-employed, no employees. He has a solo 401k account for himself. He can put $69,000 a year in there. His contributions, he can self-direct it. We do it all the day, all day. Every day we're setting up a new solo K for a client here at Directed. All right, so now that solo 401k, he ended up setting up an LLC. That's an optional thing. You don't have to, but that's what Toby has now. And now it's investing into another LLC where it's maybe owning 2%. I don't know. It's a big syndication that owns a big apartment complex. It looks like a 140 unit multifamily property. Now, I don't know that Toby's 401k owns 2%. I'm just running with the example there. So, and this other 98% is just other investors. Okay, so in the end of the day here, Toby's solo 401k is really the owner, right? Because it owns this LLC 100%. So that money's all going to Toby's solo 401k. Now, they have used debt to leverage the purchase of the apartment building, which is common in a syndication. They're going to raise capital from investors, and then they go use that capital to buy a property, which they'll also get debt on. Now, in the solo 401k, there is no UDFI. So in this example, Toby, there is no what's called unrelated debt financed income for the purchase of this. Unrelated debt financed income is basically a tax that can apply to an IRA. It's exempt for 401ks and real estate, but it can apply to an IRA when an IRA uses debt to leverage its purchasing power. So for example, if my IRA bought a property for 100 grand and it put 40,000 of cash into it and got a loan for the other 60,000, the IRS looks at that and says, we'll let that 40K not be taxable, kind of 40% of the profits you make on that deal. But the other 60K in the deal, that's not retirement account money. You didn't put that in through contributions or growing the account. You're trying to juice and buy more assets. We'll let you do it, but you got to pay tax on the profits from that debt piece. So 60% of the deal in that example with your IRA is debt. You make 10,000 bucks on the deal. The IRS is going to say, 60% of that is not IRA money, so you don't get the no tax treatment. 60% of that is debt. We're going to make you pay tax on the debt. And so in that example, let's say you sold the property and had a 10,000 gain, you'd pay a 20% long-term capital gain rate on, again, let's say you made 10 grand. So that'd be 6,000 be subject to the debt, paying it a 20% rate, 1,200 bucks. So that's how it would work for an IRA. Again, I got a whole chapter in my book on this, UDFI. We've done podcast episodes on it, webinars on how UDFI works. But one of the unique benefits, I should say, of a solo 401k is they are exempt from UDFI on leveraged real estate. That is it. I want to be very clear on that. There's other types of UBIT. You're flipping properties, doing real estate development. Let's say you're doing that with a solo K. You still have UBIT. You're using your 401k to buy equipment. I had clients to do that where they're like buying heavy machinery, equipment, construction equipment, and leasing it out. Still subject to UBIT. The exemption is when the 401k is investing in investments, whether it's buying it itself or in a syndication, and there's leverage debt for the purchase of real property, like a multifamily building here, like a single family rental. In those examples, the UDFI does not apply to the solo 401k. That is it. Leveraged real property. Okay, I want to be very clear on that. Otherwise, the UBIT rules apply the same to IRAs and 401ks. That is the only difference is UDFI on leveraged real estate. That's where the exemption lies. All right, let's see what we got also on the Ask Matt. Wow, we actually got a lot of questions here in Ask Matt. Thanks everybody for getting those questions in. By the way, there's a number of questions here that I have on just kind of business, S Corp, LLC, tax questions. I'm going to come back to those later. I just want to hit the retirement account specific self-directed questions because today's class is Self-Directed IRA Summer School. So I'm hitting the self-directed questions first. I'm going to prioritize those. All right, Jose asked, he says, "Hola, Matt. I'm 26 years old, first generation Texas resident. I began contributing to a Roth 401k account a couple years ago." By the way, the fact that Jose, 26 years old, first generation Texas resident, is already putting money into his Roth 401k is pretty freaking awesome. Now he says, "I've not put much money into it, a lot more than most 26-year-olds, Jose." He says, "I only have 12,000 in it. I will leave this job soon and I'm interested in making a rollover into a self-directed account, but it seems like there's different options. I would like to start off in real estate by investing in tax liens. What's the best account to roll over in order to make this possible? Perhaps a checkbook IRA. Okay, let's diagram this out for Jose. This is a great example. He has a Roth 401k. Okay, oh, that's terrible. My handwriting sometimes, I got to get better. But Jose says he's got a Roth 401k at a current employer that he's about to leave. So when he leaves, Jose knows that he can roll that out to a Roth IRA. Okay, he's already got Roth dollars. He didn't get a tax deduction when he put the money in. That money grows and comes out tax-free. But he can roll that out when he leaves into a Roth IRA. Now, that Roth IRA can be self-directed. Of course, you would want to use the best company in self-directed accounts. You want to use Directed IRA. Get over to directedira.com. Anybody can book a call, by the way, with one of our team members to learn how to set up an account. What's the process? How do I roll the money over? And we'll go through and answer all those questions for you. Okay, now he's got the Roth IRA set up. He rolled over the $12,000. Now, Jose is like, all right, I want to buy tax liens. I've heard a checkbook IRA is the way to do it. Now, a checkbook IRA is essentially what we call an IRA LLC. Some people call it a checkbook IRA, but what we call it is an IRA LLC. So now what's going to happen here is this Roth IRA is going to own an LLC, which is then going to go out and do the tax liens. This is what we call the IRA LLC. Some people call this combined a checkbook IRA. We call it an IRA LLC because it's two things. In this example, it's a Roth IRA and it's an LLC that the Roth IRA owns 100%. Now, the LLC is going to have a bank checking account. That's why some people call it a checkbook IRA. This is one of the main benefits of the IRA LLC is you have an LLC business checking account. That $12K that got rolled over from the Roth 401k goes to your Roth IRA, and then the Roth IRA invests it into the LLC. Now, for some people, an LLC is very helpful. If you're going to do tax liens, like Jose says, where you're buying tax liens and you might have to kind of work those to get payments in, or you're hoping to take over the property at some point, which is kind of the play on tax liens, that can be a lot more there's a lot more administration to that, paperwork, money going back and forth. When you own the property in particular, it becomes more of I shouldn't say a burden, but there's just more work. So the LLC is very beneficial to you if you're investing in tax liens or real estate, you're rehabbing or flipping properties or a rental, whether it's long-term or short-term. We like the IRA LLC for that. If your IRA is investing in a startup or a private fund or investments like that, don't worry about the IRA LLC. Just have the self-directed Roth IRA go right into the private fund or the startup or the small business, whatever it may be. But for many real estate investors, tax liens in particular, having your own LLC where you can have a bank account and you're manager of the LLC so you can quickly act on behalf of it could be very advantageous. So Jose, that's what I would look at doing. Do the Roth IRA and then do an IRA LLC owned by the Roth IRA. And that's the entity you'll use to go do tax liens. Now, we did have at our self-directed IRA summit, we did a special directed IRA podcast episode where we had Dr. David Anderson Sr., if I get his name right, tax lien investor out of Georgia. He showed how he used his Roth IRA, by the way, to buy a tax lien for less than 100 grand that ended up resulting in a property that is now worth millions, could be worth up to 7 million once fully developed out, but is at least worth millions right now already just as raw land. This property is it's in Augusta, right next to the Masters. Very interesting deal. He broke it down for us, showed us all the records. We were able to pull it all up on Zillow. It's super interesting. And that was a deal he did in his Roth IRA doing tax liens, because that's what he does. He does tax liens, and that's what he's good at. He's learned. He's got a whole team. He's got a broker. He's got lawyers. He's got researchers, and that's what they do. They go look for good deals on tax liens. And of course, their hope is that they'll buy this tax lien, which is a county selling, someone owes property taxes on it, so they'll go sell the lien. The government doesn't want to be owed money, so they'll go sell the lien to investors that will buy the rights to that lien, which can allow them, if they don't get paid, to foreclose and actually take the property. And so that's what a lot of tax lien investors are trying to do. They're getting property that's been neglected or people aren't caring about. Sometimes they have value, and the owners of those property just have their head in the sand, or they don't understand what they're doing, and they're just failing to pay the property taxes. So sometimes there's some investment opportunity there. That sounds like something Jose might be looking into. So that would be something, though, I would use an IRA LLC for. All right, let's get to the next question here. Oh, man. Some of these are tough, I got to say. This might be the honors class, Self-Directed IRA summer school. This is not like the dropouts that couldn't graduate on time and had to take summer school to get their diploma. This is like, oh, this is a little more serious here. All right, this was a question from Gavino. Said, in one of your videos, you show how to use an IRA to invest tax-free. Can I use a 401k the same way to take out a loan and invest in stocks or crypto, and will it be tax-free? Okay, Gavino, no. When we're talking about using your IRA or 401k to buy real estate or invest in crypto or small businesses or private funds, like we're just talking about changing the account from a broker-dealer to a self-directed custodian. See, when you have an IRA or 401k on Wall Street, I hate to say it, Fidelity or TD Ameritrade or Charles Schwab or Vanguard or whatever, when you go to invest that account, it's an IRA or 401k, and they're going to let you buy financial products, stocks, bonds, and mutual funds, because that's the business they're in. They just happen to also let you do it with an IRA or 401k. But your IRA or 401k doesn't have to just buy that. Under the retirement account rules, it's not forced to just buy stocks, bonds, and mutual funds. So what you can do is you move the account. We're not taking a loan out or a distribution. You move the account from the TD Ameritrade or the Charles Schwab over to a self-directed IRA custodian. There's 20 or 30 companies that do what we do. We happen to be the number one and the best in the business. So why would you need to know the other companies? But we're the best at directed IRA. So, but you move your account to us or a portion, and now you can buy real estate or crypto or private companies or any of these non-publicly traded assets. And you can do that tax-free. If it's a Roth account, by the way, it grows and comes out tax-free at retirement. Now, when you have a 401k, one of the issues on a 401k, and let me go over this here, is when you have a 401k and you want to self-direct it, well, how do I get access to it? If you still work at the company and you're not yet retirement plan age, which is 59 and a half, that money is most of the time stuck in the 401k plan. So if it's an old employer 401k, it's fair game. We can move that money out now. You can self-direct it. You can get to a self-directed IRA. If you're working at the company and you're over 59 and a half, you can move the money out. Even though you still work there, it can go to a self-directed IRA. No problem. But let's say you're 40 years old and you work at that employer, and that's where all the money is in that employer's 401k. That money can be stuck until you leave or until you hit retirement plan age of 59 and a half. Now, there's one big exception to this. This is called an in-service rollover. About 2/3 of 401k plans allow for what's called an in-service rollover, where you can move money out of the company 401k to an IRA, even though you still work there, even though you haven't reached age 59 and a half. So that's called an in-service rollover. Now, typically the pot of funds that are available to do an in-service rollover is the company funds that the match was, or any profit sharing that the company may have put in to the 401k for you. Your employee contributions, they can lock up until you leave or hit 59 and a half. But any of the employer contributions, once they're vested, are able to be rolled out in what's called an in-service rollover. Now, the majority of 401k plans allow for this. This is not a question that the entry-level customer service agent for the 401k administrator is going to know. They're typically going to ask you, do you still work there? And are you age 59 and a half? If you're like, yeah, I still work there. Yeah, I'm not age 59 and a half. They're like, you can't move the money. You can't touch it. It's stuck. But you have to specifically ask, but I want to do an in-service rollover. The plan allows for in-service rollover, even though I still work there. This is typically in your 401k adoption agreement. So just a little tip there for people that have a big 401k or some type of 401k where they still work, they're not leaving, they're not close to retirement age, and they're like, dang it, I want to self-direct this, but my company just has restricted investments that I can do. How do I self-direct it? Look into the in-service rollover. That's a great option to get money out. I've done it with many clients over the years. It's not that it's complicated. It's just you got to cut through all the tape that the 401k administrators have to figure out how to freaking get access to the money. All right. Let's roll over to, oh, good Lord. All right. Let's finish this one. This is from Deanna. Now, Deanna is a CFO of a company and has a very complicated question here. I'm just going to say this, Deanna. I really love that you asked this question on my website, but you really need a consult with a tax lawyer for an hour or two to figure this out. But I'm still going to answer it here. I'm just going to say this might not be the complete picture, but it's an interesting question, so I want to break it down for everybody to understand. Okay, let me get into Deanna's question. Deanna says, love the podcast. Said, I have a complicated question that many lawyers, tax accountants probably couldn't answer correctly. I love it, Deanna. So why not throw it at Matt? I'm game. She says, the company I work for is selling an LLC it owns 100%. The parent company is an S Corp, and I'm the CFO and 4% owner through exercise stock options. All right, I'm going to stop here and start diagramming this. Okay, there is an S corporation. It owns an LLC. Deanna owns 4%. The other 96%, I don't know, presumably one owner, the majority owner here. I'm not sure. We get into this later. She refers to this person as boss. We're going to come back to that. Now, all right, so this is where we're at. All right, just want to outline this. She's also CFO at this company. Now, she says, I want to buy the LLC personally. It is a cash cow of a company. Essentially, the owner, my boss, we got him over here, was afraid that I will leave the main company over here, the S Corp, if I buy the LLC. So instead, he will let me invest up to 30% into the LLC for 3 years, and then he will sell it to me 100%. We're going to come back to this and start writing down these percents. In the meantime, we will continue to run it as we do now. Originally, I was going to use a Rob's 401k to buy 100% of the LLC because most of my cash is in 401ks and IRAs. So now I have to switch gears and was hoping to use a self-directed IRA to invest about 20% for now. I've read conflicting information about prohibited transactions and minority ownership in an LLC. Now, Deanna, here's why you're receiving conflicting answers and information. First of all, a lot of people talking online about this, if you're Googling around, don't know what they're talking about. Second of all, the people that do know what they're talking about, you might be stumbling into, are talking about different situations and scenarios that have different fact patterns that are going to determine what you can and can't do. So it's very hard to read those and understand in a very complicated scenario what you can and can't do. Now, I'm still going to try to break it down for you. I don't have complete information, but I'm going to give you a couple of ideas. So let me just say this to anyone doing deals like this. Do not rely on a freaking YouTube live for Matt Sorensen answering this question. I mean, I'm here to give you general advice and guidance about what you can or can't do in a general situation. It's educational. It's not specific to your situation because I don't know all the facts. But I'm still going to try and answer this for you here, Deanna. Okay, so she says, can I have a self-directed IRA invest about 20% in the LLC without breaking the rules since I have 4% ownership in the parent company and work in an officer role? My compensation is not tied to performance of the LLC. Okay, as to your first question, Deanna, yes, your self-directed IRA, okay, this is Deanna's self-directed IRA, could invest and buy 20%. Presumably, this goes down to 80%. Now, I'm presuming boss over here is unrelated to you. It's just person you work with or owner of the business. You know, it's not family or anything like that. So we could do that. Your IRA could come in and own 20% of this business. Now, the next question was, can I also invest personally a small percentage to own 5%? Yes, that's possible too. So you could own 5% here, Deanna. We got you down here. And then we're down to 75%. Okay, I'm okay with that, by the way. This is a little tricky, but I'm okay with this. And just know there's some slight prohibited transaction risk, but I don't see anything yet. Because when it's buying from here, it's really buying, I presume, this S Corp's ownership is selling to you. And so you're not a disqualified person to the S Corp. Even though you're an officer here, you're not in a control position of 50% or more. And so I think that's okay for your IRA to buy in here at 20%, and then for you to personally come in as well at the 5%. Then she says, when he's ready to sell out to me, what are my options if it's owned partially by my self-directed IRA? Can I sell the IRA ownership back, roll my IRA funds into a Rob's 401k and purchase the entity outright that way? Probably not, but what are the other avenues? All right. By the way, Rob's 401k, I'm not a huge fan of. It's possible. I need to know what you're trying to do here. Are you going to work in this LLC later at the end of this 3 years? Is this going to be turned into your job? If so, the Rob's 401k is the only option. This is called a rollover on business startup. However, this LLC will need to turn into a C Corp. Corporate tax, you're going to be paying more taxes, 21% max. And that's even before money comes down to your IRAs and 401ks. So you're going to pay more tax here. So I'm kind of like, why do you want the retirement account to come in? I know you said earlier this is where you have most of your money. So I want to try to find out a way to make it work. But why is your IRA or 401k? I just don't know why I would want to use it here. So generally, I like an IRA or 401k to own something because it's an asset that's going to go up in value, or maybe it's going to cash flow real estate or interest payments or something. And we want to build that up in the retirement account with no tax. If the goal here is to own an operating business that cash flows, I don't know that I love having a retirement account own it. Now, this will be subject to UBIT. This is an operating business, I presume, that sells goods or services. And so it's going to be subject to UBIT. Now, you could do the C Corp election here to avoid UBIT. By the way, again, this is freaking honors. If everyone's like, what the hell is Matt talking about? This is a high-level question. We got Deanna, the CFO here, asking it. So, by the way, I love you, Deanna. This is a great question. But so this gets complicated. In other words, it's not a cut and dry example of when I would use an IRA or 401k. If this was my IRA or 401k, the only reason I would care to try and push this to figure out how to make it work is if I thought that business could sell for a large gain. And I wanted that large gain to go into a Roth IRA or a Roth 401k tax-free. Otherwise, I don't know that it makes sense to push the IRA or 401k into the deal here. Now, again, Deanna, you may be like, well, Matt, I need the cash. The seller of the business will only sell it to me for cash. And I don't want, that's the only way I can do the deal, period. And the only way I have money is in my IRA or 401k. So if that's the case, if that's the only place you have money is in your IRA or 401k, let's again talk about it. I get a consult with one of the lawyers at KQS Lawyers. Even at Directed IRA, by the way, we cannot help you with this. This is a complicated tax and legal scenario of what you can and can't do. We can help at Directed IRA in terms of your account, what are your options, and kind of the common things. That's easy for our team to do here, and they're very experienced and knowledgeable. But if you need real structuring and tax and legal advice, you're going to need a tax consult with this. So I get over to KQS Lawyers for a consult with one of the attorneys if you haven't already yet. So in summary, it's possible. Let's just focus on why are you trying to do this? If it only is because this is where you have the money and you have to use the cash to do the deal, let's maybe work through it. If it's like, no, I want to do Roth dollars and do this tax-free, it might be worth working through it. If you're like, well, I just want to do it in my retirement account instead of personally, I don't know that it's worth it in this scenario. The last thing I'll say is, Deanna, if you're not going to work in that business, like day to day running the business, I wouldn't even worry about the Rob structure, super complicated. I would just do a self-directed IRA to own the business. You're going to have UBIT. We can still do the blocker corporation to avoid that. But I don't know that the Rob structure is worth it unless you plan to work in the business. So by the way, your IRA can own a business you don't work in. You don't get a salary. You're just manager, investor, owner. You can have say and control, but someone else is running the day-to-day business. So lots to think about there. We did do a podcast episode, by the way, on investing in a small business with your IRA or 401k. And we're going to do that, a new updated version on that shortly as well. But Deanna, that's where you're going to want to go to get more information on that. Investing in a small business with your IRA or 401k would be a great place to go. All right. We got any live questions, Tristan? Okay. All right. Where are we at on time? Okay. We got 10 minutes left. Okay. Let me do rapid fire on the other questions people asked that were not on retirement account topics that are very interesting, something you guys might want to know as well. So let's go over to YouTube. This was from Sunshine Girl. And Sunshine Girl asked, are DBA names required to be unique in the state like an LLC? Yes. When you set up an LLC or corporation with a state, you have to make sure no one else is already using that name. If you submit a name that someone is already using in an LLC or corporation, it's going to get rejected. The same is true for any DBAs or fictitious names or anything like that. The state's also going to look up and make sure no one else is using that name in the state. If they are, it's going to get rejected. So before you set up a DBA or you think of an LLC or corporation name, make sure it's getting checked. If you're working with a lawyer, like in our law firm, we automatically check this before we set up your entity and go to the expense of drafting all the documents and starting to file everything. So we're going to check this for you. But yes, it's going to apply to DBA names as well. Make sure you have a unique name. All right, another question on YouTube was Jovan, who asked, if I have an online business, will the state matter where my LLC is incorporated? Yeah, it does. And Jovan, usually we want to set up the LLC or corporation or LLC taxes and S Corp in the state where you live. Okay, so if you're in Arizona and you've got an online business, I'm not going to go set the LLC up in Wyoming or Delaware or something like that. I'm just going to do an Arizona LLC or an Arizona S Corporation from the very beginning. That's where we're going to have your entity set up because that's where you're going to get taxed. All right. Now, I know the big hang up for people is those of you in California. You're like, but Matt, I live in California, but I'm doing business online in all 50 states. I don't have a physical office. I work from home. By the way, that's your office. Where's your server? Where's your computer? Where are you accessing or doing business online? Where are you shipping things? And the fact that you actually live in California, there is no way around avoiding California. So set up the entity in California. Even if you try to set it up in Wyoming or Delaware, they're going to still force you to pay the $800 fee in California because you live there. If you're doing anything in the state of California for that business, you're still going to owe the franchise tax fee. You're not going to get around that. So I know a lot of people are pissed off that live in California because of this franchise tax they have for LLCs and corporations. It's called the gross receipts tax for S corporations. And I know it's freaking crap. I mean, but that's the state of California. You chose to live there. Sure, you can play games to try and get around it, but it's not legit. If you're actually conducting business in the state of California, you're logging onto your computer to check its orders, to check its sales, you're shipping something out. If business is actually getting conducted in California, my guess is for all of you with online stores, because you actually live there, you're doing something. Doesn't matter where you're going to set up the entity, you're going to have that $800 annual fee, you're going to have the franchise tax board. So we're not trying to avoid that or go to other states. Now, if you own rental real estate in other states, we might avoid California and have some ways around that because it's a property that's actually located there and try to have minimal contacts and business actually being done in California. But just be careful thinking you can get out of state taxes or state fees. For example, California being one of the big ones people are trying to avoid by setting up in another state, even if it's an online business. And I know, Jovan, it's like, not probably what you wanted to hear, but we're typically going to set up the LLC in the state where you reside, which is generally for those of you with an online business where business is being conducted. Now, if you don't love that and you're like, screw California, you got to move. You got to move. That's how you get out of it. And by the way, you're going to get out of all the income taxes too that you have there too. And I know that's not possible for everybody, but otherwise you're just going to have to, deal with the taxes or, run for office or something in the state legislature for governor. I don't know. I'm trying to give you something to do about it, trying to be productive about this. Okay. All right. Tim asked, this will be our last question, unless we have anybody popping off live. Okay. Tim asked, I registered an S Corp in Delaware for what I thought was to be a business-friendly environment. I now see it as not the best place to be. Wyoming seems to be the favorite these days. What is the process and what needs to happen and cost to change the registration? Okay, great question, Tim. You can move an entity from one state to another doing what's called a domestication. So you can move from Delaware to Wyoming by what's called a domestication. We're doing these in our law firm all the time, clients moving entities from state to state. Now, Delaware used to be the hot place to set up an entity. We never loved Delaware as lawyers, for small business lawyers. Delaware is kind of a big deal if you're raising capital, you're going to be a publicly traded company. The only business-friendly rules Delaware had was as to shareholder lawsuits and management and stuff like that. But the reality of those business-friendly laws has been totally destroyed with Elon Musk's case and Tesla. the Delaware court upended a majority of the shareholders and board of directors who voted in favor of Elon Musk's compensation because they thought it was too excessive. And a minority group of shareholders were able to challenge this and win in Delaware court. Because of that, Elon Musk has moved Tesla to Texas, which is where he's actually conducting business now. They had no attachment to Delaware. They were like many people that thought, oh, I'm just going to set up my entity in Delaware because that's what all the people say, not realizing the reality of it. Well, Tesla got stung and they lost in court despite overall shareholder and board of director approval. So for small business owners, though, Tim, there was zero reason to go to Delaware unless you lived there. Okay. Just set up the entity in the state where you're doing business. Now, Tim asked, what about Wyoming? We like Wyoming for maybe holding companies, if you got $1 million of assets or more, but otherwise, I would avoid Wyoming even. I would just set up the entity in the state you're doing business, Tim. If you have a business in Colorado, just do a Colorado LLC or corporation. If you own a rental property in Minnesota, have a Minnesota LLC own that rental property. We're generally not setting up entities in states that you have zero attachment to. The only exception is Wyoming, which we do use for holding companies or privacy for assets, not for operating businesses though, for assets. So if you need to change the entity though, you can do what's called a domestication of the entity. That'll move it from one state to the other. In this case, you can go from Delaware to Wyoming. Give our team at KQS Lawyers a call. You go to kqslawyers.com. We'll try to drop the link in there, and the team can get you an appointment with one of the attorneys to go over that process. Sometimes, I will say this just as a heads up, Tim, and for everyone else, we will just dissolve the entity in Delaware. Unless it's got a lot of business activity or things already connected to it, sometimes we'll just dissolve it and then set up the new entity in the proper state. But let's say you've got a lot of things happening. You've got bank accounts, merchant accounts, assets in the name of the entity. In those instances, it does make sense to domesticate it. It still stays the same entity. It is just incorporated under a different state. So we change the state of incorporation. All right. Well, thanks everybody for all of these questions. I felt like that was the fire round. A lot of high-end questions, a lot of high-level questions here. Like I said, this turned into the honors class of summer school. Not my intention. That's what you guys decided by the questions you sent me. I'm just here to answer them, whether they're easy or hard. And I want to thank everybody for answering the question, for being on live. Make sure you're subscribed to the channel. Also, go over and join the private Facebook group at Team Wealth. We're going to be adding more content there, connecting more and more over there. But please, at a minimum, be subscribed to the YouTube channel because that's where we're going to become giving you updates. We're dropping new videos almost every day on ways to better take control of your financial future, taking control of your retirement like we talked about today with self-directing. We will see you next week. Thanks, everyone.